Let's talk about this with Jim Paulsen, Wells Capital Management in Minneapolis. Jim, good day to you.
Thanks for having me.
I want to talk about this oil idea first, but let's talk first of all about the dollar as a litmus paper of the total system. Bring up dreaded first chart right away. Trade weighted major. We've shown this chart. It is a weaker dollar. What does that signal to you?
Well, I think a couple things. I think we, against developed world currencies, Tom, I think it signals that the Federal Reserve is behind much of the rest of the developed world in terms of the retightening pattern, and we're leaving a rate structure far less than they have it. But in terms of the emerging world currencies, I think it reflects a movement back towards more free setting of currency rates as opposed to what's been going on for the last couple decades, where emerging world are setting their currency rates at artificially low levels. So I would say it's a correction where the dollar needs to weaken against the emerging world, and ultimately that's going to help correct our trade deficits in this country, bring more trade flow back here. So I think it's kind of a two-tier deal, one against developed currencies, one against emerging.
Did we see exports to the rescue today with the trade statistics? With a weaker dollar, we're supposed to do better as an export nation. Are we seeing that?
Well, the interesting thing about the relationship between changes in your currency rate and changes in the real trade deficit is it's about a 2-year lagged relationship. It's been fairly consistent, about a 2-year lag. So what we've been seeing in the last year is weakness in our trade reports month after month after month. It's getting worse. That reflects when the dollar surged in its value from the summer of '08 until about March of '09. And if you put a 2-year lag on that, that's the weakness that we've seen in trade flows. The good news there, Tom, is that since March of '09, the dollar's weakened a lot. And so I anticipate that in the months ahead, starting in this quarter, we're going to start to see trade improvements and trade actually adding to real GDP growth for the rest of this year.
Let's go to your great research on $4 gas. This is a great chart, folks. I was not aware of this. And I thank Jim Paulsen for this. 2011 $4 gas, we're at $3.77 now, is not 2008 $4 gas. And we look at non-farm payrolls. We see it typically the first Friday of every month. It's that headline statistic. And it rolled over into '07, '08. And you say now, Jim Paulsen, it's dramatically different than it was then.
Right. I mean, there's nothing great about $4 pump prices. It's irritating for all of us. But there's a difference between it being a recession risk or just a irritant at the pump. If you look back in '07, '08, the payroll employment growth was already slowing. And as oil was taking off from $85 in '08, the payroll employment growth was falling below 1%, and it would go very negative. This time around, as it's taken off late last year from $85, it was rising towards 1%, and it's henceforth gone up to 1.6% now in the last year. Job creation has notched up. If you look at where we were last fall, we had $85 crude oil, but we were creating about 100,000 private payroll jobs a month. Now we got close to $110 crude oil, but we're creating 200,000 jobs a month. And of those two circumstances, the latter, I think, is far better for the overall economy, Tom, even though it's irritating to have $4 pump prices.
Well, let's talk about that further. It's on everybody's mind, including Alan Ruskin's note of the day. And it's real simple from Deutsche Bank and Ruskin. Reality hurts. Oil is going to do damage to U.S. data on both trade and inflation. Much of this was predicted, but reality still hurts. Jim Paulsen, when you look at oil and this reality we're in, we saw that in the NFIB statistics this morning. Okay, is that like a one-off? Do we feel better about oil in June or July?
Well, I think there's no doubt that the rise in energy costs is going to crimp growth, and it's certainly going to show up in first quarter GDP numbers, where we're going to probably grow only about 2% in real GDP terms. But I also think that there's a difference between slowing the growth rate, which I think what is happening right now, and killing it, which is what happened in '07, '08. I think to get to the point to where it's likely to create a recession risk, we'd probably have to have pump prices move a whole lot higher. We're more into the mode of a slowdown right now. And personally, Tom, I think the emerging world is, the tightening that's gone on from China is starting to slow the emerging world growth rate, and that's why I think we're starting to see commodity prices peak out.
Oh, good. Let's leave it there. Jim Paulsen, nice overview.